Testing 1, 2.
Hey, good morning, Sean. How are you?
I'm good. In fact, I'm way better now.
Way better now? What changed?
Well, I have something to do now. I have some things I can buy.
All right.
This is where you make a lot of money from. So we can elaborate on all those teasers as much as you want.
Well, we can and we will. But I want to get two things out of the way. Number one, your market take, as you had called for some a bearish tone to come into the market, and we've got this nice little bounce today in the market, and we've got a little bit of a monument with Apple crossing the $1 trillion market cap. I know that you're not necessarily the biggest bull of Apple, and I don't suppose that you're just going to jump into this now, reaching this $1 trillion market cap. But give us your thoughts not only on the market, but then recap Apple's earnings. I think they kind of tie into each other.
Well, yeah. In fact, I mean, the easiest and most simple answer is that I do think we just have to correct. I mean, so people can put blinders on, and they can say, oh, hey, you can make all sorts of justifications and reasons that, the market at all these lofty valuations. Again, it's not really the market. It's roughly, 8 to 18 to 28 stocks at the most that have driven the market up. So there's still, hundreds, if not thousands of stocks that are very reasonably, in some cases, ridiculously cheaply valued. But hey, the market cap is the market cap, and the indices are market cap weighted indices, and a very small number of stocks have become $500 billion to $1 trillion companies. So, that's what's driven this pretty historic now on quite a few valuation metrics, pretty historically expensive market. So, but I think the shortest answer and the simplest answer is just Apple's good report. And by the way, it was a very good report. I mean, this is, if you remember, I wasn't like super enthused about trying to lay any big shorts in front of this quarter. Mm-hmm. And in fact, I'll give Apple credit. I mean, the quarter was probably good enough that I'll look to other things to short, because everything that's bouncing off of Apple's good report, because it's levitating the market, are probably better shorts. I mean, for example, a newer bounce, an Adobe bounce, the top 10 components of the IGV, save for one name, which is Oracle. You just go down the laundry list. A lot of the FANGs have bounced pretty good. Tesla's bouncing pretty good. So there's probably a lot better shorts than Apple. And I was never really one. I mean, I've actually shorted Apple pretty well, I think at least 2 or 3 times this year. But they've been very, very well-timed shorts, and they weren't big. I typically like to go for a 25 to 100% move in pretty much everything I do. But those Apple shorts, I mean, I was pretty happy with the stock dropping, like 5 to 10%. I mean, that's kind of all I was looking for. I mean, Apple is definitely a very well valued, reasonably valued company. In fact, it's funny. On CNBC the last 2 days, they've been all about a thing I used to write about 2, 3, 4 years ago, which was Apple's arguably the best company in the world, and they were they traded at like half the PE or less than half the PE than like names like Procter and Gamble and Clorox and consumer brand companies, which are basically GDP growers. So these big old stodgy companies that pay an okay dividend and grow at about 3 to 4 or 5%, that PE is of like 19 to 22. And, net of cash, Apple's PE was like 7. Even if you include the cash, Apple's PE was roughly 10, 11. So it's like, it's kind of ridiculous that the best company in the world is traded at half the valuation of like a Procter and Gamble. And yet, you didn't really hear much of that 3, 4, 5 years ago, when, by the way, the stock was, a 200 billion market cap company. Mm-hmm. So, but now that everybody's kind of using that argument. So, it's like whatever. Something that they're talking about now doesn't very excite me if I identified it 4 or 5 years ago.
All right. So where are we on your NASDAQ call? Is this just another opportunity to short? You think it's
I
played
think
out?
so, because I think now, again, you might want to just do it today. You might want to kind of let things kind of show you that they're winding up to kind of, either you let it blow off, or you kind of let it show you that there's some tiredness, there's some fatigue in the to the upside, which is exactly how the last. I mean, we have almost a 300 point, maybe even more. It was a 400 point, three to 400 points of Nasdaq decline, and it kind of came after a fair number of days of kind of fatigue. So I don't know. I don't know if we're going to kind of blow off and then drop, or if we kind of have that fatigue type setup where, hey, maybe we have good news and we just don't get any lift off of it. But yeah, I really think the Apple report, and again, was a good report. Stock probably deserved to go up. Although again, a lot of this is priced in. Apple's not nearly as cheap as it was. The PE is nowhere close to 10 or 6 or 7x cash now. But yeah, I just think the Apple now. Here's the counter. And I don't want to be like a technician who says, well, if this happens, this will do this, but if this happens, this, I don't really do that. Have a scenario for every contingency. I more make calls. The other one thing I will say is earnings reports are still really good. I mean, the biggest thing that anybody that's got a bearish bent, and again, I'm not really bearish on the broad market. I've never said that the market has hit a durable or permanent top. I just think of again, we have a pocket of bubbles. We have these small subsets of bubbles, which unfortunately do represent a pretty big part of the market. So we just have to kind of see how that happens. But hey, global growth is good, and I think it's still expanding. I think the people that are talking about sort of this recession setup, as early as next year, I think they're going to have a lot of egg on their face. We might have a recession by like 2021 or something. But, it's taken a long time. It's taken a long time to get the world in the condition it's in now. Meaning, it's taken a long time to get the world in a position where everybody's kind of syncing up and producing growth and buying and selling from each other. Because what's been the last, I think we talked about this 1 or 2 times ago, the last 8 years have kind of been a healing up from the financial demise of the post-financial apocalypse of 2007, 8, 9. So, and that was only 8 years after a stock market crash before, the technology bubble crash of 2000. So, I'm not sure if we ever in our history had 2 crashes in an 8-year period of time. Some people would say the 29 to 31 and then 1937, there was a big market downturn. But I don't really think 37 was a crash. Might have been a 25 to 30% downside move. So I'd have to go back and look. But really, we had an unprecedented, 8-year period of time. And then we had a lot of healing that's occurred. So, we'll see what happens. But I do think Cloud, IGV, Adobe, Newer, one of my names I was short, man. This one I didn't have to cover it, but I did, was Varonis, VRNS. I mean, they caved huge on their earnings report. I think they would drop like another 20. Names like Shopify haven't reacted. They had a pretty good report. They went down. Red Hat's never really, it's bounced, but it's still looking weak. So there's plenty of names that look vulnerable on the short side. And all it's going to take is once sort of kind of everybody has pumped up this Apple price short term and it's kind of hit a peak. I think then what was already transpiring can basically hook in again, which was the market was kind of looked to me like it was going to have a pretty decent correction.
Well, that doesn't mean that we still won't. The odd thing about today is that we really don't have much in the wake of headlines that's driving this. We knew what the narrative was to drive us lower, and that came out last night. But as far as today, very healthy pullback on no particular news.
Yeah, I mean, well, again, we're at levels where we don't really need. We can go up or down, any given day, obviously, but I don't know, NASDAQ where it is, Dow where it is, you know, we can really go either direction. But I mean, this is just Apple. I mean, Apple's kind of sucking all the air out of the room. I'm sure we're going to talk about some other positions, but there have been some good reports that haven't been rewarded. And it's just because all that algo money has to flow into Apple to juice it up. It takes a lot of money to move Apple, and that sucks a lot of air out of the room. But hey, where Apple goes, so go the indices by and large, especially the NASDAQ.
All right. Well, so you had teased a little bit that there's some opportunity to make money, and even though we've got the NASDAQ up, I presume that there are some stocks that you have on your radar if you haven't already bought some, taking advantage of some of the weakness that we've had over the last, couple of sessions.
Yeah, no, I'm going to post some sort of updates, but Twitter had been talking about buying again. People get excited at the wrong time. Again, I'm not here to try to change people's behavior because people are going to behave how they're going to behave. But my view is I get excited when Twitter's 32 and I can buy it. I don't really get excited when it's 46 and kind of plotting higher. In fact, when it was at highs, I was trimming it. There was a question about that, by the way. Anybody wants to look at notes? I had several notes in June that I talked about trimming Twitter, and I mean, there's plenty of times we've talked about it on the radio. So the bottom line is, and also I'm always going to say this: you shouldn't have to sometimes always state if a stock triples off of lows, and I was buying those lows, I'm going to be trimming. In fact, I'm going to trim roughly a third of my position because a triple off of lows means your position has increased threefold. So just to keep the position still right sized but even overweighted, if you trim a third, you've effectively sold the total dollar value of what you had invested at one time, and you still have 2/3 of the position. So it's just kind of a good lesson to think about. If you do hold stuff to a triple, at a minimum you should take a third off, because you basically took out your whole investment already, and you're sitting on a lot of gravy. So I wouldn't let the gravy get cold, so to speak. But the bottom line is, I think people get excited when Twitter's 44 and goes to 47. That doesn't make me excited. What makes me excited is when you get a pullback that's actionable. And again, the quarter was good. I mean, I think we were on the radio probably 6-8 months ago when Twitter was, I don't know, it was the last big pullback after a report. I think it went from 27 to 22 or 27 to 19. I can't remember the exact stock price. But again, I just get more enthused and more excited because the opportunity to make money is far greater from here than it was at 47. So I'm talking, from a positioning standpoint, not selling it, but putting more on right here. Same thing could be said. I'm going to talk about FireEye for a second. Now, I haven't talked about this, and frankly, I'm growing disenchanted with the name. But here again, unlike most other people, when they grow disenchanted, what do? They sell it. Oh, I'm just going to get rid of it. I'm tired of it. Tired of looking at it. Yeah, I've had a lot of positions go 2-3x once I get disenchanted with them. So because if you're disenchanted with it, it means the rest of the world's disenchanted with it. That probably explains a lot of the price action. So in other words, again, try to kind of think to where you're positioning yourself where you're not on the same side of the boat as everybody else, because that's where the opportunities are. So I'm not going to sell, no way in Hades am I going to sell FireEye here. I'm not sure I'm going to add to it, but I would say this: if I didn't have any, I would be adding to it because it's ridiculous again. That FireEye is absolutely ridiculous at 15. It's ridiculous that it's selling off on the quarter. They basically said, if I were to grade the quarter, it'd be like an A. It's not an A+, but really wasn't that far. The only thing they really could have done is shown better top-line beats. But, this is a software company. A lot of times, things like deferred revenue, things like bookings, things like increasing customer subscription ads, those things don't show up immediately. They might show up in 3 months or 6 months or maybe even 2 or 3 quarters. So the bottom line, if you really understand the ins and outs and what makes like software companies tick, So I almost guarantee you, in fact, that we'll probably see more upgrades of Fire out here pretty soon. Because, if you're looking at this company and let's say you didn't like it and you're trying to find fault with it, it's much harder to find fault with now. And in fact, after a quarter like this, I'm probably going to increase my price target, because I can model in 20, 22, maybe even 25-ish% future revenue growth, where that was kind of hard to do 2 or 3 or 4 quarters ago. But the bottom line, billings is up 21+%. I mean, there really was like almost nothing bad in the quarter, except it just wasn't a big beat. So this might be one of those cases where, again, I was very fervent about talking about Twitter, like what a great opportunity it was probably 2 or 3 quarters ago, and because people were selling off a quarter, which I said, wait, that was a really good quarter. And I'm going to say that with Fire right now. It doesn't mean I'm buying it. Maybe I'm not. And there's a simple reason. The simple reason is I bought Sina yesterday. I've been buying a lot of Twitter. I'm also buying MTSI. If I were to rank names, I definitely favor Twitter. I definitely favor, especially from where I picked up Sina yesterday. So really, I always evaluate everything versus what my other available options are. And honestly, I probably if Twitter was 40 and Sina was 52 and MTSI was 25, I'd probably be buying FireEye today. But those 3 particular stocks, I think, are giving me a really unique situation. And what did I always say about Sina? I always said that Dialogue was never going to buy them. So, to me, Sina was a more likely buyer. But Sina basically pre-announced positive, and the stock went down. So I'm pretty comfortable increasing this position into the quarter, which I think is about a week ago. So if it wasn't for me favoring Twitter, Sina, MTSI specifically, I'd probably be buying FireEye today.
What do you think?
The quarter was that good. This stock, by the way, this stock is going to be 21 to 25. Probably inside of 9 months, if not inside of 5 months. So I'll just end it there. Anyway, what were you going to say?
Well, I was going to ask you what's your take on the divergence on a name like FireEye versus a name like Fortinet and some of the other cyber names.
It's the same thing. I mean, they like Fortinet because they've liked it. No, I mean, we can laugh about it, but I do think. I mean, I think it's funny as well. I mean, just I guess they like to buy stuff at highs rather than buy stuff that's cheap. So that's how I'm able to make a lot of money over and over with the very high hit rate. Is that I just don't need to swim where everybody else is swimming. Now you might get a little bit more instant gratification sometimes swimming where everybody else is swimming. But I don't know. If I'm, you're just not going to make. There's just not that much opportunity. If I were to line Fortinet up, by the way, I don't think it's a bad quarter. By the way, Fortinet was a very, very undervalued company for a long time. So I don't think it's this is not one I would say. Even though the chart is a big, kind of 2x type mover over a fairly compressed time. In fact, it's a 3x mover off those ridiculously crazy 2016 lows. That was such a good time to buy tech stocks. But it's almost the antithesis of 2016, basically, for Fortinet. They kind of had a period. They weren't doing well, then the whole sector got rocked. They really couldn't produce numbers worse than they produced back then. Now, kind of everything's hitting for them. But yeah, I mean, you see this, I mean, FireEye will make a way bigger move, or said better, maybe. They will move way quicker from 25 to 40, so that's 15 points, then they'll move the next 10 to get to 25. That's how stocks move. But the bigger percentage move is the first 15 right now, because the first 15 right now will be a double. The next 15 won't be a double. So same thing. It's just easier to Fortinet's having an easier time going up, 10 or 20 points, let's say from 54, 55. That it had to do a lot of heavy lifting to get from 27 to 47. You know what I mean? Mm-hmm. So it's just the way stocks move. It's I guess I'm just going to call it algorithmic money flow. And then, just the psychology of what people do now. Again, I like the fact that I feel like every year that goes by, there's fewer people that do what I do. So it makes my opportunity set that much better. I think it's going to come full circle, by the way. I think I wouldn't be surprised if certain things happen all of a sudden, maybe 2, 3, 4 years from now, fundamental research is back in vogue again, right? It really has been out of vogue for quite some time. Value investing has been not popular for quite a long time now. So I won't be surprised if value investing comes back into vogue, but probably not anytime soon. It'll probably take another 2 years or so.
Well, it's going to take a pretty steep correction. That's what happens.
Well, I was just going to say, you're going to need fear, right? You're going to need people to lose a lot of money in the names that have been the favorite pile-in, same side of the boat names. And once you have people that lose their, where popular names drop 35 to 55, maybe even 65%, then all of a sudden people will go, oh, I guess I shouldn't have done that. And then they'll try something different.
Yeah, and it's just like any other market. Whoever's allocating funds to funds of funds and whatever, the big returns are coming from momentum names. What I hate to use the term like quick, fast type money, but that's really what it is, and other funds need to keep up with that pace. When the market just goes straight up and buy the dip just keeps working and working. Value investing, it doesn't get those type of returns because it takes longer.
Well, what happens is it actually can, I still bet if you were to line up a lot of good value managers over the last 10, 15, 20 years, the much higher percentage of them has probably beat the S&P 500. It just, here's the difference. The difference is your daily variability is a lot higher.
Sure.
What I mean by that is a lot of shops, props, funds, they literally measure P&L performance versus their benchmarks on a daily. They might be doing it on an hourly basis now. And I would argue that the more they do that, the less well they do. Like here's one of my heroes is David Tepper. I can guarantee you David Tepper does not care one iota how his funds do on a daily or weekly or monthly or even quarterly basis. He might not even care that much each year, because he's, over his career, he's had years he's gone 100, 150% in markets that have done 20 or 30. He's had years where he's taken huge hits where the market hasn't done that bad. But in other words, it's really hard to score big if you are in line with the market. Because the market is average. The market is it's average is the masses. The crowd is the masses. If you're just swimming in the same water as everybody else, you're going to get the same experience. You're going to be average. You're not going to beat anything. So I don't mean I'm not trying to sound like I'm on my high horse here, but go read Warren Buffett letters. I could guarantee another guy. He could give. He couldn't care 2 cents if his fund is up or down on a day, meaning, Berkshire Hathaway's portfolio is up or down on a day, the NASDAQ's up or down. He could care less, I guarantee you. So in fact, what he may care about, what I care about, what David Tepper may care about, they may actually try to find stuff that actually doesn't move with the market. Because that's really what you want to do to outperform. This is getting kind of esoteric, by the way, but in market math, you actually try to find stuff that doesn't move with the market. Because you have a higher propensity of beating the market. So you want non-correlation and you want alpha. Those are the holy grails of the truly gifted money managers. Whereas, most people, the whole industry pretty much nowadays is just built on closet indexing because it's safe. You're probably not going to lose your job if you're within, 50 to 60 basis points of the return of the S&P 500. But yet, you're not really getting anybody anything.
All right. Well, what are some of the other names that you're finding attractive?
Well, again, this has been a really interesting week. I still think it's worth talking about Pandora. So Pandora, even though this is, hey, this is double. Now, I don't want to be accused of being a momentum chaser, but hey, I was on this name cheaper. But this thing just sets up. I even said this. When it was $455, I said this thing could double and still be just ridiculously cheap, and it's still there. But here's what's interesting. I could say that their quarter might be one of the best quarters they've reported for sure in a year, but maybe even in, well, I don't know if it's 2, but maybe 2 years. I mean, it was actually a quarter where a lot of fundamental evidence sort of started turning for them. Better ad buying metrics, some better user engagement metrics, even just the raw topside numbers were pretty decent. You guys had a good blurb on color on quarter. I would kind of encourage anybody that's interested in Pandora to either go back and read the color on quarter, then read my comments. But I mean, this thing could make a pretty good move. I might even buy more of it. I actually missed it. I was looking at this like 1 or 2 days before earnings. Unfortunately, I think it coincided with the day where I was buying quite a bit of Twitter or something like that. But it dropped. And I just don't, me, I don't like buying stuff literally 20 minutes or 40 minutes in front of the print. I will do it once in a while. But I was just sort of looking at that going, God, 7 and lower before that print does look pretty good. And sure enough, the recorder was good and they bounced pretty much back to highs. But again, 13, 12, 15, 16, I don't know. Put a number on it. I don't think it's going to have a hard time getting there. 25 is pretty heady right now. They'd have to do a lot of heavy lifting to get to 25. But $8 is still very cheap stock. I mean, I probably should add this back to my focus list, because even though it's kind of a wonky name and it's kind of weird, I might have had this on here at one point, but it just almost has too much upside to kind of ignore. And this is, sometimes this is how I like stuff. I'd like catching stuff as cheap as I can. At the same time, as long as something's very fundamentally cheap, I have no problem buying it up 50, 60, 100% if I feel like there's a lot more room. And I think that's kind of where they are. But anyway, go back and look at color. I think they caught a couple upgrades off that or a couple price target bumps. But I still think ultimately what's going to happen with Pandora is they might get to 10, 12, 14, 16, so, something pretty significantly higher than here, and then you get an M&A deal. I'm actually surprised this company hasn't been. If I had controlled the purse strings of multiple companies, Microsoft, Amazon, Apple, Google, make the who's who list of all the stocks that are moving the markets, I would have bought Pandora already. It's like a no-brainer buy. You're buying audience, you're buying a really sticky platform, you're buying known revenues, and then maybe that's kind of all they need. If they had somebody that put a lot of money into them, they might be able to really go toe-to-toe with Spotify. Right now, they're probably a little bit capital constrained, and they can't quite make the investments to their platform that Spotify can. But anyway, I really like Pandora a lot. Again, MTSI, let's just talk about that 2 seconds, and then you ask me whatever. So this is another one where that quarter was good. Of all the stocks that I cover and own right now, I'm probably the most surprised that they didn't have a decent spike bump move on the quarter, because there was really no hair on the quarter. It wasn't a big, easy to see top line beat, but basically there was almost no underlying metrics in their business that didn't show improvement. China wasn't much of an issue. Data centers good. Their core verticals, their industrial verticals and stuff were pretty good. So, I don't know. I think there was a laser maker, IPGP, which might have reported kind of bad around the same time they reported, and maybe that tainted the MTSI report a little bit. But again, this is just this mid-small cap company that I think there's general disinterest with right now. But same thing, there wasn't really much on their report that I didn't outright like. So, and I would say that they're probably a quarter or two from really starting to inflect. And like I said, I would say the odds of beats start increasing going forward now for them.
All right.
Again, just really, really cheap. This is a funny thing. This is a stock everybody loved between like 58 and 66, and now nobody even talks about it at 21. I mean, this is like a no-brainer to like 45. So that's probably where you'll find that I become disinterested in MTSI when it's 45 to 48, and then everybody else gets excited and it goes up another 10 points. But this one lines up really good, and again, as I said, probably the biggest surprise that it did not get any kind of love. I mean, I thought for sure when I looked at the number and I read the report, and especially when I read the metrics, I'm like, this thing's going to be up $2 or $3 tomorrow. And that's what I thought. I'm like, in fact, I was kind of going, God, I hope it's not up more. But here it is. In fact, it even went down. Like the first 10 minutes of trading, it kind of had a spike down move of like $1. I have no idea what that was.
Do you cover MIXT?
Mm-mm.
No, not
it doesn't ring a bell at all.
Okay. There was a question on this MIXT, and this is the listener saying it's another great quarter and a great call. No idea how the stock is still under $20. It's in the internet software and services space, so I thought maybe it might have been one of the ones that you covered from time to time. Couldn't remember off the top of my head if it was.
Remember I usually look at all these around the time when they IPO. Now, if it's been around for 10 or 15 or 20 years, I don't know. There might be some reason that. But if I look at them and I don't really like the TAM, meaning the total addressable market, and don't see that it can be a sort of a $500 million to $1 billion plus revenue company and still grow a lot over that amount. A lot of times I don't really look at them that much. So I have no idea why, but I don't even know if I know the symbol. And I know I know literally thousands of symbols.
MIXT is the symbol.
I don't even think I've seen it.
They IPO'd in September of 2013, and they're at a level. This is a pretty attractive looking chart, I think.
You know why I might not know? So I'm looking at the company description. You know what company I did really well with? Fleetmatics. It looks like these guys are, I'm guessing, they're in the same space as Fleetmatics. Fleetmatics was bought out, by the way. But Fleetmatics was a very nice stock for years, and that was a stock I liked. I mean, it was kind of one of those stocks, every time the market corrected or tech got, mid and small cap tech got hammered, I would buy Fleetmatics. I literally think, I don't think I ever lost money buying Fleetmatics. But yeah, so my guess is I probably ignored these guys because I like Fleetmatics better or something. But honestly though, I don't know if I've ever even seen the symbol. It doesn't ring a bell.
Well, there you go. Maybe you do. Do some homework on this one. We've got a listener who his what he had to say sounds a lot like you. Another great quarter, another great call. No idea why this stock is under 20. It really just had that same type of resonance that you like to say. So hey, I don't know. Throw that on your radar. Check it out.
I do see it's located in South Africa. That I wouldn't say that's a hotbed for technology.
Tech,
yeah. There's little warnings. Like right there, that puts me off. I would much rather have a company based out of the EU or US or something.
Yeah, that makes sense.
Yeah, I mean, even a China-based technology company, I honestly might prefer over a South African-based technology company. I mean, I don't have any prejudice against South Africans. In fact, I have friends who are South Africans, and one of my favorite all-time golfers of all time is Ernie Els. But I'm not sure I really want a technology company based out of South Africa. So right there, I've got two strikes. One, Fleetmatics. I used to like them. They got bought out by a bigger. I'm trying to remember who bought Fleetmatics, by the way. It's escaping me right now. I cannot remember who bought them. But so you got Fleetmatics is in their space. By the way, Oracle's tangentially in this space. A lot of and they either used to have a division, they may have sold it to somebody, but Oracle had a big fleet management product and process in space. So we'll see, but I don't know if they still have it. They may have sold it to somebody, but there might be some tough competition. I might take a look at it. But yeah, hey man, what I always say: if something is working for you, keep doing what's working for you. It doesn't matter what anybody else says.
All right. Well, we'll touch back on that one at a later date. All right, where should we go now? Let me see what some of the other ones were that might have been for you. I'm going to go back and check it out. Is there anything that over the last week or so since we've last spoken that really caught your attention from earnings?
Well, yeah, okay, so this is more sort of Apple ramifications, and then some other. So one thing I've noticed, and I was pretty negative on the semis for a while. Well, a lot of the semis, pretty good reports this quarter, and from beaten up levels. The stock I kind of am mad about. I don't woulda, shoulda, coulda very often, but I was looking at ESIO, which is Electro Scientific. They had a whopper of a quarter. I think we're up 10-15% yesterday on a huge beat. So like names like Lam, ESIO, CLAC, that's KLAC. And then the Apple report. So I'm not so sure it'd be super smart to be super bearish on semis right here. Maybe let them run pretty good, or just change the tune. I mean, when the facts change, I'd change. Lam was a name I didn't like before, and they did drop a lot. I mean, that stock did go down a lot. Avago went down a lot. Skyworks went down a lot. I'm starting to kind of moderately warm up the Skyworks again. But, we're getting pretty close to another Apple cycle. And so I'm not going to be as bearish on Micron now. I've got to respect some of the good reports that were produced. Again, I should have been in that ESIO because I really like the market cap. I like the size. It had a huge pullback off highs. And there's still some good reports going on in the semis, but the two names, and again, they both got a little bit of a lift off this. But what is my big theme on Apple? And I mean, in a sense, I'm sort of long Apple because I'm so long 3D sensing and bullish on that thesis. And I am very surprised. So the second biggest surprise after MTSI this week is that Light hasn't moved more. Because, Light being one of the top two providers of 3D sensing for Apple, the other is Finisar. But they've popped a little, but not much. I mean, put it this way, they haven't popped nearly as much as Apple has. And I think these stocks both will move way, way more than Apple. So that's just kind of curious. And again, stocks don't have to make sense every day. In fact, they don't. In the short term, they move much more on algorithmic flows and fund flows, institutional support, and things like that, than really fundamental criteria. But Apple didn't say anything bad. If you kind of know how 3D sensing is going to proliferate, what's going to happen, and how many more handsets are going to be involved, and other types of technology, everything Apple said is pretty much full bull on 3D sensing. So, where's their focus? AR, VR, more enhanced capabilities of the iPhone, more real-time monitoring, more real-time communication, talking to cars, talking to other devices, Internet of Things, blah, blah, blah. That's where Apple's going, right? So their devices are going to be with you, and they're going to help you connect with the world around you. That's 3D sensing. That's Internet of Things. That's all that stuff. That's the whole reason why Apple's putting more chip content into their phones over time, to allow their phones and their watches and their iPads to have more capabilities, right? So the only question I really have is how many of the Apple devices will have 3D sensing enabled technology? I don't know. I doubt it's still going to be one. They only had one before. But I think it's going to be at least two or three. Could be. I mean, I don't know. Could be most of their phones. It wouldn't be that hard or that costly to put 3D sensing enabled chips in most of the iPhones. I don't know. I don't know. I'm not as up on this. I used to know everything about their supply chain. I don't know what phone they're going to quit making this round and what. So, they always do that. They make a new phone and they quit making one or two old designs. So that's the only thing. I don't know how. I doubt three. I don't know if they're going to keep making like the 6s. But it would not be hard to put 3D sensing in pretty much anything that's called the iPhone 10 or iPhone X, any of the 8 models, and if there's a tweener model that comes out. So that's going to be a big deal. But again, very, very surprising. Given the strength of the Apple report, especially given the guide and given the very positive commentary about the iPhone X, what do they call it? iPhone 10? I have a hard time not calling it the iPhone X. Anyway, the fact that the 10 was the biggest seller, blah, blah, blah. I mean, that's all very positive commentary for 3D sensing, yet 3D sensing stocks didn't really do much. So again, I think we'll get a delayed reaction, and these stocks will end up having an outsized move off of the Apple move.
All right, and one of the listeners wanted to get your take about buying CBLK pre-earnings report.
I would say I'm in it. I'm kind of buried. I think I'm down about $3 or something in my CBLK. I'm still, my mode is I'm being very particular in what I'm buying, because what I'm buying, I'm increasing tactically and meaningfully. And again, I really like Twitter. I really like Sign. I really like MTSI. So, and I'm not one. I don't need to try 10 or 15 or 20 trades. I have a pretty good hit rate. So once I decide to go with something, I go with it and let it work. But yeah, I mean, I kind of wish I didn't have any carbon black. I might be buying it now and saving myself some money. But I think the setup's okay. It's popping a little bit today. In fact, it's popping pretty good now. It was only up about 60, 70 cents when I looked at it before. But yeah, I mean, like I say, 22 is better buy than 24-ish wherever I did. So I like it. I don't have a big position here. I still, I still line up the security space as CyberArk and FireEye are my main positions. One's worked really well. One hasn't done much. But then I've caught some other big moves in some of the other names that I'm no longer in. But yeah, no, I think carbon black would be okay. I think, in fact, the opportunity is probably in names like this. And I think a reader asked me about Hortonworks. That's another name. There's not really been any reason they've sold off other than, they dropped with the NASDAQ. And in fact, you and I were talking about the fact that there was kind of the stealth correction. This might have been 2 calls ago, but how a lot of stocks, started falling. And the Russell 2000 had put in a pretty good down move. And that actually started happening, I want to say 3-4 days before the NASDAQ finally had their kind of rough little 2-3 day period. But we still haven't had much of a correction in the Russell, by the way. I mean, what are we talking? Maybe a 3% move lower, if even that. So, but I like that stuff. I mean, that's all the stuff I like, and that's all the stuff I would basically increase is the mid small cap names that could have a good report that have been beaten up for no particular reason.
All right. We also have another listener who wants to get your thoughts on the 3D printing space, and in particular SSYS.
I don't really that every now and then I do kind of give up on a space. Now, this, full disclosure, this was my one of my best short ideas in 2014. So I always talk about the spring of 14, and that this period I thought lined up well with the spring of 2014, and the one area that was super hot and crazily overvalued were 3D printing stocks. In the spring of 2014, and pretty much they went down. The whole industry basically dropped about 80% and hasn't really recovered. Long term, thematically, I kind of like the industry, but honestly, I haven't done much with the industry. I haven't really done much with any of the names. So I would say that I may get re-engaged with this group. I'm probably not the best person to speak about it now. I've put my focus elsewhere. I will say this, just from a structural standpoint, technical standpoint, this industry, this group of stocks is now running, I think it's roughly a 3, if not 4 year bear market. And it's full bear. It's like 80% bear market. Yeah, at some point you can get a pretty good propensity for a comeback. Here's what I don't know anymore. This is what I used to know, but what I don't know now. Have any big companies made inroads against the smaller innovative companies? So, at one point, this was led by a small group of stocks that dominated all the technology, and none of the big technology companies were involved in the space. So, the Triple D, SSYS, I think Exfo or X1 or something like that. There was a few names. And I always thought that, hey, will a Hewlett Packard buy into this space, or will Microsoft buy into this space? And nobody really bought any of the emerging technology companies in the space. But I think that HP has done quite a bit of internal investing on their own. So that's the one thing for me to get reacquainted and answer that question properly. I would have to go and look and see, hey, what has HP done? Has Microsoft done anything? Has Apple done anything? Is there any pending competition coming from the big boys? And I would say if there's really not much, then at some point these names will probably be pretty good to own again. I do watch them from a chart perspective, and I do look at SSYS. If I were to line up the group, but this would be the name I would go to, by the way, SSYS. So I would feel comfortable saying I know enough about it to know that, hey, if I were to get back in the space, that this would be the name I would do. But I don't know. I think it's a decent speculative bet. I mean, $22 because your downside, you probably know your downside because you can see it on the chart, and these guys haven't gone away yet. And if you get an outsized upside move, you probably get there's really not much resistance until like the mid 30s on it. But like I say, I just rather do what I'm going to do. I like the names I've been buying. I like to focus what I'm doing. I'd be hard pressed to want to put money in that space over things. I mean, like a Redfin. I would just why would I want to buy a 3D sensing stock over Redfin right now, given what I know and the attention that I've put into it? I could be wrong. Maybe the 3D sensing space is about ready to go rocket ship again. I don't know. But I would say it's a good spot to speculate, just from a chart action. On fundamentals, I've moved on and I'm focusing on other things.
Maybe a company like Smith and Wesson will buy them so they can't make the guns. They'll just buy them and then destroy the company so they can't duplicate any of their any of those.
Honestly, I mean, this is sometimes it's worth being involved in a group on just on the outside chance the whole industry could effectively be bought. So I jokingly said a few years ago that one of the big technology companies should just literally buy out the whole fiber optics space. And they could, at one point, you could have literally bought out the whole fiber optics industry for, I don't know, $3 or $4 billion, right? And now you have single companies that have a $3 or $4 billion market cap, or certainly a couple of them just combined do. So, I don't know. What would it take to basically buy out the whole, to acquire pretty much all the R&D and all the intellectual property of 3D sensing companies? I mean, you got 3D, SSYS. Again, I think X1's still out there, maybe a couple others. I know a couple have probably gone bankrupt. But, hey, if you're one of the few companies out there that kind of locks up most of the IP, intellectual property of the industry, it could be pretty smart. Again, there's all these obvious things that I think would be super obvious if you had Microsoft's financial wherewithal, yet they never do stuff like that. So I don't know. But it's hard to kind of blame them to say that they've done poorly when the company has done pretty well. But I don't know. I could say I think Microsoft could have done way better. I mean, again, you have all these companies that could basically just kind of create mini Berkshire Hathaways with their cash, and yet none of them do. And it's probably one of the easiest business models to copy. It wouldn't necessarily be the easiest business model to execute because finding truly good talent and money management is pretty hard. But tons of companies have plenty of stock, plenty of currency to go create investment portfolios, yet not very many of them do. By the way, Google's done an excellent job. That's why I always called them the Berkshire Hathaway of Silicon Valley. They've probably been the second best investor outside of Berkshire Hathaway long term now.
All right, let me see if there
But so
are
3D
any
sensing,
others.
though, I might have to kind of look at this. I mean, this, it is enjoyable to hear what other people have to say, because it kind of, sometimes we all can get kind of caught up in getting comfortable in doing what we do, right? So it's like anything else. Sometimes it's kind of good to get out of your comfort zone and maybe to look at, and by the way, I look at hundreds of stocks, so it's not like I'm not looking at enough stocks. My coverage list is at least 300 or 400 names, but hey, what's another one or two? I might have to look at this 3D sensing group again. I do love that weekly chart on it. I've been sitting here looking at that chart ever since you asked me that question, And the longer I look at it, the more I like it. And not the daily, but the weekly chart.
SSYS?
Yeah. But, I can't remember the last time the stock actually spiked on a report. So this is just knowing what they typically do. Now, there could be a time where they finally have a good report and they spike, but even when they spike, they tend to fade hard. And just, again, thinking about algos and thinking about what happens to these small and mid-cap companies, usually you get a chance to buy it. So, maybe sometimes it's better to wait until, you kind of know what's going on. I mean, by the way, you could have waited until, now I'm very happy I was buying Twitter at the lows, but I could have waited and I could have bought Twitter between 23 and 26 and still made a ton of money on it, right? And what I'm saying is at 23 to 26, you kind of knew that the turnaround was firmly in place at Twitter at that time. But 26 from where I was is I would have missed a double, or very close to a double, and I don't like missing doubles. But at the same time, could have bought Twitter at 24, 25, and still made plenty of money. By the way, that's why I like it again. I mean, 31, 32, 33 is a pretty big drop from where it was.
Yeah, indeed. I'm sure. And it's also bumping up against the 200-day. Pretty close, anyway. So you would expect that to, at least if it makes a run. It hasn't touched it yet and hasn't touched it for quite a while. So you still got that in favor of Twitter. It hasn't, let's see, October of 2017 was the last time it had been this close to the 200-day moving average, that being Twitter.
Well, what's really interesting about now some people may not like, to me, Twitter's still in a nice uptrend. Mm-hmm. It has violated the bottom channel of the uptrend, but I mean, what I like about Twitter is it still acts like a stock. And I kind of joke about this, but Facebook and Amazon and Netflix haven't acted like stocks. And what I mean is,
like commodities.
Stocks like just drop. In any given year, they have X number of X% drops. They also have X number of times they trade below the 50-day. They have X number of times they trade below the cloud. You know what I mean? That's what stocks do. Even good, healthy, strong stocks that have doubled or tripled or gone up eightfold still have normal moves, and these normal moves are short-term moves of violence, right? That's normal. You get violent moves up and you get violent moves down. I'd much rather trade stocks that are acting normal and rationally. And again, we could say it's irrational that Twitter dropped as much, but the stock is still acting like a stock. The FANG stocks haven't acted like stocks, which again, this is when things are perverse, they unwind in perverse ways. So that's the thing you always got to be careful of. If something hasn't acted like a stock, when it starts acting like a stock again, I mean, it's going to be ultra violent. Because because basically something should have had, let's say, 15% corrections in the last 3 years, and they've had none. Well, what's going to happen? It's going to make up a lot of those moves that should have already occurred very rapidly on the next bad catalyst you get, right? And that's why it's just like the risk is compounding and increasing over time. The longer these things trade unnaturally. That's the best way to say it. All right. So I'd rather just not be involved, or take some short bets from time to time.
All right, so last question for me, and if I talk to you next, we'll call it Tuesday or Thursday of next week, is the NASDAQ going to be higher or lower from this point?
I'm going to say lower, but a week is a tough time frame. But the fact that we've bounced as much as we have, the fact that Apple had a good again, I mean, you can say what you want. Apple saved the Nasdaq. I mean, the Nasdaq was. I mean, we were 400 points away from you and I going, "Hey, good job, you did it again." You called another 800-point Nasdaq down move. So, and by the way, I'm not. I don't have any ill will against Apple. for quelling my prediction, right? That doesn't bother me. In fact, honestly, I'd rather see Apple do well. I'd rather see stocks that deserve to go up. Apple's finally kind of gotten due that it probably should have gotten years ago, and I like to see that because again, that's rational. I like to see stocks behave the way they should behave, right? But yeah, I think we maybe have another day. We could kind of finish the week strong. with a decent day tomorrow. But I mean, what's going to happen when the first day Apple's not up? Because what's not really happening. The FANGs aren't really going up anymore. I don't think the Tesla bounce is going to be super long lived. So now, if a bunch of companies can keep reporting exceedingly good reports, then there might be some lift. But there's not that many big reports left, meaning market cap wise. There's a lot of big reports to me. By the way, Acacia reports tonight. That could be kind of cool. Arista Networks is one I always watch. Again, I used to love that name. So Sierra Wireless is another name that I own a smallish stake in, that reports tonight. So there's some interesting stuff that's still happening. But and you can correct me if I'm wrong, but I don't know if there's any of the uber large market cap companies are left to report. I'm trying to think if there are. I mean, we've gotten through all the FANGs, right? Netflix. We've gotten through a bunch of the big software companies, but okay, maybe Adobe. I think Adobe reports late in the quarter.
Yeah, they usually do. I think.
Yeah, but even a lot of names like Shopify, Alti, HubSpot. I mean, a bunch of these cloud software names have reported. Again, Splunk reports late, but see, Splunk doesn't really move the market. Splunk kind of does its own thing. It kind of can dictate the movement of some of that cloud security and data stuff, but it doesn't really tend to move the indices much. And so maybe that's about all that's left for the big boys. It'd be like names like, I'm not sure Workday is reported. I'm pretty sure Splunk and Tableau Software have yet to report. So there's a few of those kind of names. But again, I kind of think we're past most of the big boys.
Yeah,
the biggest market cap names I think is largely reported now.
Yeah, and we'll move into the retail names that start to report. So a lot of the
by the way, this is when I tend to like earnings season, because now when the mid cap and small cap stocks report, they don't get completely swamped by big reports, right? So if a Finisar reports, they might be reporting on a name where there might be very, very little intellectual competition in the tech space, right? Meaning there's just not too many other techs reporting that day. So it's pretty much this is the tail end now. Now maybe you can start getting some better trading moves on some of these names. But yeah, I think it's, again, Apple saved a correction that I think was actually started, and the good Apple report basically quelled it for the time being.
All right. Well, I think that's a good place to stop, and we'll see how few of your names report, and I think we'll probably touch base probably early to mid next week. I guess we'll see if there's a bunch more names that you have a lot of demand to get your take on from our listeners. We'll get you on, I'm sure.
Good enough.
All right, my man. Well, hey, as always, thank you so much for getting us up to speed on a lot of these ideas. You got a lot of new ones, and you know what? The listeners provided some homework for you as well.
I'm gonna have to look. By the way, there's a couple people that have been that got me into watching Tesaro. I'm not in Tesaro. I think they report tonight. So I'm just putting a ping out there for you Tesaro fans or Tesaro watchers to be on the lookout tonight. I'm pretty sure they report tonight.
All right, fair enough. Thank you as always, Sean. Enjoy it.
Take care.
All right, you too. Bye-bye.